Before we even get into the data or the market updates, there's something you need to understand immediately. What happened with Opendoor yesterday was not normal. If you follow this stock or pay attention to how the market usually behaves, you probably felt something was off. After digging into the dark pool activity, short volume, timing of trades, and the latest regulatory delays, it becomes very clear that yesterday's movement didn't follow natural market behavior. There's something deeper going on, and by the end of this breakdown, you'll see the entire situation differently. I'm recording this during the pre-market, and Opendoor is currently up around 0.22%. It's not a huge move, but it does show the market reacted somewhat positively to today's economic numbers. And what's interesting is that today's numbers don't really match the weakness we saw yesterday. Yesterday's ADP employment data came in at negative 32,000, when expectations were positive 15,000. That was a weak reading. But today, challenger job cuts were significantly lower than expected at 71,000 instead of 98,000. Initial jobless claims were also strong, coming in at 191,000 versus the 220,000 forecast, the lowest since early 2025. That's normally the type of data that pushes growth stocks higher. On top of that, the market is currently pricing an 89.2% probability of a 25 basis point rate cut. Rate cuts usually increase appetite for risk, which benefits companies like Opendoor. But here's where things get unusual. The broader market was green yesterday. Tech was green, growth stocks were green, yet Opendoor spent most of the day moving downward. What makes that even more strange is that the majority of actual transactions coming in were buy orders. Institutions were active, dark pool buying was happening, and yet the price continued falling. That doesn't fit normal supply and demand behavior. It fits algorithmic pressure. Short interest also increased noticeably yesterday, and that aligns perfectly with what we saw. When new short positions are opening while institutions are buying and the stock still drops, that suggests the price is being forced down rather than naturally drifting down. And then, right in the middle of all this, the SEC dropped a quiet but extremely important update. The transparency rules that were supposed to require funds to publicly reveal their short positions have been delayed again. These are Rules 13F2 and 10C1A. Right now, institutions are only required to show their long positions. Short positions are completely voluntary. That means most of the market is operating with only half the information. These new rules were supposed to change that. Instead, the SEC pushed them so far into the future that they practically lose their relevance. Short position reporting has been moved to January 2nd, 2028. Securities lending transparency has been moved to March 29th, 2029. Delays this long almost always mean one thing. The rule is being put aside, buried under other priorities, and eventually forgotten. It benefits the same groups who rely on non-transparent short selling. For heavily shorted companies like Opendoor, this matters. If the rule had gone into effect sooner, many funds would have started reducing their short exposure. Now they don't have to. As for the company, there have been no new filings, no new press releases, and no new major updates. There was a short clip released from the Hope Global Forum's 2025, but nothing in that conversation was directly tied to Opendoor. Short interest is currently around 13.72% of the free float, which comes out to roughly 107 million shares. That's substantial. Now, instead of showing a chart, let me explain the price levels in simple terms. Opendoor is currently trading just below an important price area around $6.99. That number matters because stocks often react when they approach levels where buyers or sellers were previously active. Getting above that area could trigger a move toward the low 7 range, around 757. There is also a support area around 6.63 where buyers previously showed interest. Below that, there is another area where the stock has historically found stability, near the longer-term average price, which is currently around the mid-6 levels. I've seen people online calling the current setup a very strong pattern, But based on the price behavior alone, momentum hasn't fully returned yet. The stock has been showing slower movement recently, similar to what happened several months ago when it consolidated for a period before making a stronger move. This time, for the stock to show meaningful strength, either the market needs to fully embrace the idea of a rate cut, or Opendoor needs to release significant internal news. Algo activity yesterday was unusually high, which adds to the argument that the move wasn't natural. When you combine aggressive algos, increased shorting, and strong buying from institutions, yet the stock still trends downward, the behavior points toward coordinated selling pressure. And the timing of the SEC delay only makes the situation look even more questionable. The rule was supposed to roll out in early 2024, then moved to late 2024, then pushed again, and now all the way to 2028 and 2029. When a rule designed to increase transparency keeps getting delayed, it becomes clear that it isn't being prioritized. And investors in companies like Opendoor pay the price for that lack of visibility. For now, Opendoor's movement will depend heavily on whether the market believes the rate cut is truly happening. Without that belief, or without strong company-specific updates, the stock will likely continue reacting to short-term forces like short volume and algorithmic pressure. Disclaimer: this video is for entertainment and informational purposes only. It is not financial advice. Always do your own research and consult a licensed financial professional before making investment decisions.